monologue by the moderator of this panel, CNBC TV 18's Latha Venkatesh. So Latha, can we have you up on stage? And also, I'd like to invite our panelists one by one. I'd like to invite our panelists one by one without wasting any time. First up, the head of India Equity Research and India Equity Strategist at Morgan Stanley, Ridham Desai. Then we have the head of India Equity Research at JP Morgan, Bharat Iyer. Next up, the head of India Research at UBS Securities, Gautam Chhaochharia. And last but not the least, head of Research India at Macquarie Capital Securities, Rakesh Arora. Okay, Latha, it's over to you.
Yes, we can. So maybe you can start with a round of applause. Let's at least start with a bang. Well, this year India has been one of the least bad markets, as we are repeatedly told, and we don't have these guys to thank. It's not the FIs who did it, it's the domestic investors who did it. But the foreign investors have kept the faith, to be sure. It's the market from which least amount of money has gone out. This is the index, which is down only 5% compared to several of its partner countries or peer countries, which have lost anything between 10 to 25, 30% in terms of value, and even more, much more in terms of dollar value of the investments. So India preserved wealth better than perhaps most other markets. Well, so that really is the question. As we stand on the cusp of 2016, what we have to ask the big investors, the foreign investors, whether they return. Well, let me start with you, Ridham. India has been the good boy in a bad company in the current year. What's the sense you're getting next year? Do we continue to be just the good boy in a group of emerging markets which will still be shunned largely, or do you think our group will do better?
So let me start on a very somber note. Morgan Stanley published its year-end outlook for 2016 this morning. The European strategy note is titled, "So You Thought 2015 Was Tough." Let me just highlight what they expect in terms of returns for various market groups. So the US equity markets is likely to be the best performing market in 2016. The expected return is 4%. Europe is number 2 on the list, expected return is 3%. Japan is 3rd on the list, expected return is about 2.5%. And emerging markets is at the bottom of the pile with an expected return of 1.5%. So bottom line here, Latha, is that we are in a low return world. Growth is hard to come by. The world is struggling with disinflation. It is struggling with the lack of policy tools. And valuations are not exactly that attractive for equities. In fact, I would say that low returns are not just for the equity markets. We're forecasting low returns across most asset classes. So India is not a small market. It's not a frontier market. It's not a small cap or a mid cap stock which can do 30% when the rest of the market is 3-4%. So keep that in mind when you talk about 2016. Now, that's not to say that Morgan Stanley goes right. We go wrong 50% of the times, just like the toss of a coin. But it is a low return world, and if indeed our global strategists are correct, then I think we're dealing with another kind of, I would say, low return 2016. Our starting point here is that India should do better than most of the markets. It has a very good macro environment. Growth, I think, is slowly inching higher. It's certainly constrained by low global growth, but I think in the context of a low return one, India can hope to deliver double-digit return, but I don't think anything dramatically more than that is possible at the index level. Individual stocks will do their own thing, as they always do.
Okay. Well, there are two premises there. One, that emerging markets as a basket are still going to be the shunned ones, or perhaps as a basket will only do 1.5%, and India will still be the outperformer. So basically 2015 themes continuing. There are two themes that we are discussing, therefore. Uh, let me get you on that, Bharat. The first theme. Is the JP Morgan thesis also that emerging markets will continue to struggle? Our keynote speaker believes, as you just heard, that, oil has fallen enough, commodities have fallen enough, so emerging markets, the delta cannot get worse. If anything, we could perhaps see some bit of money returning and therefore more purchasing power. Do you all buy the theory that emerging markets will be at the bottom?
We'd be in that camp. Our base case is that emerging markets will deliver returns of about 10% this year, and it could be even marginally higher. I think what we are contending is with two set of factors. First and foremost, emerging markets are very under-owned in the context of global equities at this point in time. Secondly, there is a case to believe that growth, particularly earnings growth, has broadly bottomed out after 4 or 5 years of being pummeled down. So I think, if you see an earnings recovery, there's no reason why money will not flow back into emerging markets. So we'd be a little more optimistic. We'd believe that, there are returns of about 10 to 12% to be made in emerging markets.
Okay, the hierarchy would be as Morgan Stanley believes developed markets, US, Europe, Japan, EM.
I think we are slightly different in that. I think we believe that there's more money to be made out of Europe and Japan. The US probably falls in after that. And emerging markets, actually, you can't strictly compare returns from emerging markets with developed markets. But, there is a case to be made for emerging markets this year.
Okay. I'll come back to the outperformance of India in a minute, but let me get the other speakers as well on the theory of emerging markets position. Gautam, what's the theory at UBS?
So we are also somewhere in between where Bharat and Ridham mentioned. Emerging markets will still deliver positive returns, but possibly much lower than developed markets. Again, the base is favorable for emerging markets, definitely, but the growth strategy or the growth outlook is still very, very weak.
So the commodities super cycle doesn't dip anymore. Does it move up? Is that the theory on which this is based?
So how it stabilizes? So it stabilizes, under-owned, valuation is very, very supportive. So that should give you single-digit returns, but we're not expecting it to outperform the global markets.
This repeated word under-owned is giving me creeps because the one market which we want to outperform is not under-owned anymore. But to that in a minute, what does Macquarie believe? Do emerging markets, does the sun rise?
Well, we really don't believe in the concept of emerging markets anymore. Things have changed quite dramatically. And we make a big differentiation between countries within the emerging markets. So we continue to like countries which are users of commodities, because we think that is more of 2015, which will continue in 2016. And consumers of commodity, which is China and India, are going to outperform quite significantly as compared to the commodity producer countries. So our pecking order is slightly different: China, India, and then the others.
Okay, that's very interesting to believe that the commodity super cycle will be still against the commodity producers. But the Indian outperformance, let me start with you on that, since you think it is an Indian outperformance. Where does the Indian delta come from? I mean, we've already seen crude at 40 for a better part of 2015. Where is the delta coming from? The government is not going to get a second advantage of crude at 40. So, that extra, 50,000 crores that they got by not having to subsidize, that extra money is not going to come. They're going to pay more for government staff. If government is not going to invest, is private sector going to invest? Where will the growth come from?
So first of all, there's a lot of focus on earnings to really drive the market. Earnings do drive the market in a longer term, but not in the near term. It is always the re-rating or the price to earning which really matters the most. Now, we think that Indian government has been doing the right steps. The whole way business was being done in India is changing. The crony capitalism is on its way out, and businesses have to redefine what they're doing, how they were doing things, and it's been 18 months since they've been trying to refigure out. We think that things will start to, bring to shape in 2016. And as confidence returns into India's growth story, markets will get re-rated, and, I don't think investors are going to wait for earnings to come through. Earnings might come through in FY18 and 19 probably, but FY16, I believe we are more likely, FY17, we are more likely to see re-rating of the markets happening, which is what is really going to drive the outperformance.
re-rating of an already over-owned asset class. Would you buy that rhythm? Is it going to be earnings growth or multiples growth? Why would you place India as an outperformer in the first place?
Yeah, no, India is our #1 emerging market pick. So we are most overweight on India. So we are still very bullish on in an EM context, and we continue to do so. I think forecasting multiples is fraught with risk. I don't think we have a model to forecast multiples.
This far in the last 4 quarters, forecasting earnings has also been fraught with risk.
I was going to come to that. Forecasting earnings has been also very tricky. I've been horribly wrong on earnings this year. So you have to take that with a pinch of salt. Of course, if you use the gambler's fallacy, then I should go right in the next 12 months. But I think earnings are picking up, in my view, over the next 12 months. And that should be the material driver. Why I would slightly disagree on multiple is that India is not cheap. Okay, so its multiple is trading at above historical averages for the index. Relative to emerging markets is trading at a 70% premium. The last time India traded at these premium multiples was in 2007. Now, this is not 2007 because emerging markets then were trading at, say, 3 times book. India ended 07 at 6 times book. Today, India is about 2.8 times book. So, it's very different. The denominator is totally broken. That is EM. And if something goes right with EM, which is not our base case, then there is a case for India's multiple to go up. But India could underperform in that situation because the EM multiple could rise a lot more. I think the market will probably trade earnings then and then put more multiple into this equity index. What I learned from foreign investors, and we have a few of them sitting here, is that India continues to be the best house in a bad neighborhood. And that's not just with a 12-month view, but with a 3-year view and a 5-year view. So I see tremendous appetite to buy India. And whenever this market corrects, I think investors will come and buy, even though rest of the world or the rest of the emerging world may be challenged. So 2016, I think, is about some recovery in earnings, which didn't come in 2015 as we had forecasted, and maybe stable multiples.
Well, India has been described as the country of the future. Looks like it will continue to be described as the country of the future. Well, Bharat, you've been more bullish than many of your colleagues here. Well, there's one exception. Rakesh also is fairly bullish. What can go wrong? I mean, there are a couple of things which everyone has spoken about. Consumption of commodities, for one, and then earnings perhaps bottoming out. Maybe the government consumption, the government investment finally starts fructifying. Probably the seed is sown this year. But what can go wrong?
Well, Latha, if you ask me, the risks, as far as we can see it, are more external than internal. Because internally, I think we have a fairly robust policy environment. Yes, I mean, it may not be keeping pace with some exaggerated expectations that were there last year, but I guess, that's coming down to reality. I guess what we need to appreciate is that the global macro construct over the last 1 year, 18 months has been very positive for India. You had very modest growth. And the resultant fallout has been very low commodity prices, particularly crude oil, and very benign liquidity. And as we all know, India's 2 key external vulnerabilities are dependence on external energy and dependence on external capital. If either of these were to turn, then I guess, it's going to pose a risk to our markets, particularly given the fact that, valuations, as you said, are elevated. We're trading at 17, 18 times forward earnings on an earnings cycle which is still coming down. So I think I would watch out for these external variables more than internal variables.
All right. So the near consensus we are getting is that commodities are going to continue to be India favorable, that is, they're going to remain cheap, and India will remain the outperforming market. But I think I should get to the question which what all of you really want to hear. What will you buy? When it comes right down to it, what will UBS bet on? Sectors, I would prefer stocks.
I can't comment on stocks, but sector-wise, I will still bet on financials. I will still bet on pharmaceuticals, because these two will do well in most macro scenarios. For example, if
one is economy oriented, the other is a defensive. So where are your sympathies?
So I won't call pharma as defensive. They're purely growth sector, which is quite indifferent to what happens in the Indian macro environment. Financials, because it will do well in most scenarios. If growth picks up, as most of the street expects, it will do well. But even if growth does not pick up and it remains subdued, then our thesis of lower interest rates plays out. in which case financials will be a big beneficiary from lower rates driving lower NPLs, big bond book gains, etc. So I would still bet on financials.
Do I hear public sector banks at all?
So we're still constructive on SOE banks, not necessarily longer term. We still don't know how the government strategy plays out. But definitely from this framework of lower interest rates and the right policy environment trying to reform them, restructure them, it will definitely be a big positive for SOE banks also.
Well, just as Rakesh began by saying that the emerging markets as a basket doesn't exist for him, I guess even sectors is not really the way to talk. Ridham was explaining, or rather arguing about a very important trend which perhaps all of you stock pickers will be battling in your own boardrooms and research rooms. There are huge disruptive forces that are impacting all all kinds of stocks, all categories of stocks. Will it be an index buying theory at all, or is it going to, like it has been this year and last, more a mid-cap story, a small-cap story, and the index doesn't go anywhere? Anyway, what are your index returns expectation 12 months?
Well, see, obviously the driver of the market this year was mostly domestic money and domestic mutual funds who know the markets much better and have been able to invest into mid-caps, and hence the mid-cap rally. I think 2016 is not going to be that different, but there are two dominant themes which are likely to play out. One is obviously the government-led infrastructure build that we are seeing. That is going to pick pace in terms of execution. And the second theme which I feel which will pick up by middle of 2016 is urban consumption. Government has already done OROP, and the recommendations for 7th Pay Commission are out. Probably they will implement it by middle in view of UP elections coming up early 2017. So that gives me hope that urban consumption would start to look up. So these are the two dominant themes which we will look to invest in 2016 ahead of the other, obviously it is a stock pickers market still.
Well, Ridham, just to extend that argument which you were having over phone actually, will any of the Sensex or Nifty companies be able to weather the kind of disruption? I mean, if indeed, Mr. Mobius over high tea was telling us that that's unlikely, but if the solar, rooftop solar, in maybe 2, 3, 5 years became as common as the mobile phone, then are we going to see major disruption? I mean, why would you buy Coal India today? Why would you buy any of the major power companies today? Or for that matter, if payment banks are going to seriously take away the CASA of even an HDFC Bank, while HDFC Bank will be the last guy to fall perhaps, even his margins are under threat. So is there any place in the Nifty to hide to give returns, to get extraordinary returns?
Yeah, Latha, this is not a 2016 thing. The disruption that's happening in the world, I think, is persisting for the next several years. And along the way, it will destroy a lot of businesses. So I don't know which businesses get destroyed. So my approach is to own 50 stocks in my personal portfolio, because I have zero confidence in the future cash flows of the companies that I own right now, because I don't know which ones will survive. And hopefully, 10 or 12 will give me good returns and compensate for the 30 that may die. But I think we are at that...
Best guess of that 10 or 12.
Yeah, exactly. So I'm hoping. But I think we are at the beginning or in the midst of the fourth revolution in the world, after agri, industry, scientific, and now the tech revolution. And it's going to leave a lot of companies in the graveyard. So I think we'll have to think very differently about this. Concentrated portfolios, in my view, is a big risk. But again, a lot of very, very smart investors, and some of them are here, will totally disagree with me. And that's fine, because that's what creates a market. Disagreement is absolutely important to create a market. So that's about technology disruption. I don't think it's necessarily a 2016 thing, so we don't have to be positioned for just 2016. But generally speaking, if you own stocks for the long term like I do in my personal portfolio, then you want to be positioned for technology disruption over the next 3, 5, 7 years.
Then urban consumption is the safest. I mean, you'll
No.
use
I want to differ, because I think there's a lot of consensus around these things. So I'm buying rural consumption. Okay, I think it has troughed. Okay, and 2016 will be a whole lot better for rural consumption. Urban consumption-oriented stocks have already delivered very strong returns in the last 1 year. We're not abandoning all of them. I can see why retail will do well. I can see why media will do well. I think they're continuing themes. So you don't sell them, but I think it's time to start nibbling at rural consumption. Private capex, I think, is still far away. It's not happening, but I agree with his view on government capex being a big driver in 2016. I think the big drag on India is exports. I'm underweight healthcare. I think that sector is still overvalued and has delivered fantastic returns over the last 5-7 years, but we can stay out of it for a while. Instead, I'll buy utility stocks. I think they're totally beaten up. The expectations are very, very low. And if anything goes right, I think you'll make handsome returns in 2016.
Which utility? Power, you mean?
Yeah, well, yeah, generally power utilities.
Okay. Well, that's absolutely the opposite of what we've heard from some of you. Bharat, I didn't get you on this. Nobody spoke IT.
We are positive on IT.
Yeah, I got the guy.
I think two reasons really. One is, I guess, the demand environment in the US still remains very stable as we see it. Yes, there'll be changes in market share and there's change in leadership. But, that is to be expected in a sector which is gaining some kind of maturity right now. Secondly, we're all sitting and debating rate hikes in the US. And that happens only if the US economy is in reasonably good shape. And if that's going to happen, I think the dollar is going to strengthen, the rupee is going to weaken. So, you'll have that tailwind as well. So, yeah, we've been constructive on IT services for 18 months now. We continue with that stance.
Okay. What other than IT?
Well, apart from IT, as far as domestic themes are concerned, we've been a little selective. I guess there are 2 or 3 themes that we really like. One is we like financials, but only the high quality financials with a very strong capital and liability franchise. I think, this credit cycle is not going to, mirror past credit cycles where banks typically grew their way out of trouble. I don't think we have that leeway. So, we're going to stick to quality out there. As far as the investment cycle is concerned, I guess, the government has made its early cycle priorities very clear. They are focusing on 3 areas: highways, railways, and defense. So, any company that caters to these 3 areas is something to look at. As far as the rest are concerned, I think, we'll have to wait. They're more late cycle plays.
Well, when we speak financials, Samir is one man here who always bets on the non-bank financials. Not your cup?
I guess, it's a very heterogeneous space. So, it depends on what you're looking at. I mean, we like the housing finance companies. But, do we like the companies with a large exposure
Truck financiers?
Truck financiers, financiers with a big exposure to rural India? No, not at this stage. Yeah, so, we are very selective there. We like the housing finance companies. All right.
Well, I just have one more poll to ask all of you. And then we are throwing it open to our experts and the expert audience who will be questioning you. Starting with you, Rakesh, what's the in-house view on Fed hike itself? Is it December? And how many in 2016?
Okay, so our base case view is that there's 60% probability of a rate hike in December. And by end of 2016, we are looking to 1.25% overall. So that's our house expectation.
Okay, I'll just get that number and then I'll think of the impact that will have on FII investments into any emerging market asset class. Ridham, what are you all working with?
Yeah, so then that view will drive the dollar up and EM will be in pain, which is also our base case view. Our US economist has held her view on the Fed hiking in December for quite a while now. So she continues to believe that the Fed will hike in December, and then we are in a steady rate cycle. The US growth outlook actually remains quite anemic. So her forecast is for 1.8% GDP. But what's happening in the US is that because employment is approaching full level, wage inflation is coming back. And that's probably the reason why the Fed may actually hike. So we'll see how that goes. But our house view is that the dollar actually strengthens, the Japanese yen strengthens. So that those, I think,
the dollar strengthens through 2016 even without too many rate hikes.
Yeah, no, well, there will be rate hikes relative to the rest of the world. So the dollar will remain strong. And you got to put that into your trades in the India portfolio. So I agree with Bharat. You want to buy IT services over, say, pharmaceuticals, because I think IT services are more pure beneficiary of a rising dollar.
Yeah, but this clearly means that there will be a lot of disruption in currencies. If both of you expect that the Fed is hiking in December perhaps and a little bit through 2016.
But the rupee will outperform. Amongst the emerging market currencies, we are most bullish on the INR.
Okay, you too?
So we are forecasting a range of 65 to 67 for the rupee. We don't think it's going out of that range.
Okay.
And see, everything is largely expected. So what we are saying is not really out of the world.
trouble for those who have import competition and trouble for exporters as well in that case, if it's going to be such an outperforming currency.
No, I think it's good if the rupee depreciates a bit, Latha, because the rupee is actually slightly overvalued. It's hurting our
Exactly. No, what I'm saying by what you all are saying, it doesn't look like it's going to depreciate much.
No, it won't. It won't. And therefore, that is still a problem because India runs a $5 billion BOP surplus on a monthly basis. So, the flows have to stop.
This is terrible for the metal guys, yaar. None of you are expecting the commodities to do well. And they're going to be cheaper when they land. Because
No, but I'd buy energy stocks, if not metals. I think energy stocks look attractive at these levels, upstream energy.
Oh, okay, upstream energy. You mean the refining stocks as well?
Well, those are downstream.
Okay.
Yeah.
Do you mean the refining?
I think that trade is done. The upstream looks
stick
attractive.
with the cane and the ONGCs. Okay. Well, your expectation on the Fed and the rupee, therefore?
Well, our expectation is that the Fed hikes in December, and we'd be expecting benchmark US policy rates to be at 1.5% by the end of 2016. For the rupee, we believe that it should be at about 69 by the end of 2016. Agree with Ridham there that it is overvalued, and I guess there is an imperative to get the rupee down to a competitive level, not just for the sake of exports, but also to protect domestic industrial production. Because we all have to admit that we have a very large country like China next door with excess capacity in virtually everything, and not enough demand. So we're going to be very, very vulnerable to dumping, and we need a competitive currency to protect domestic industry.
Oh, absolutely. I mean, that's exactly what worries me about what you guys are saying, that even with the Fed hikes, you aren't seeing the rupee depreciating much.
And Latha, with the RBI cutting rates, which again, as I have told you
And
before,
buying dollars till they get blue in the face.
Yeah,
in
but
spite of it, the rupee is not depreciating.
Yeah, and since India opened its doors to foreign investors, the RBI has never gone against the Fed. So we have never cut rates in front of a Fed hike. It tells you how much confidence the RBI has in macro stability.
Do they cut tomorrow?
We'll toss a coin.
Okay. No, my simple point is that we are talking about dumping of steel, tires, chemicals, just about everything. That goes on. So in your estimate, we still battle a strong rupee and therefore a lot of danger to importing companies faced with competitive imports.
Exactly. Companies, sectors which are vulnerable to competition from China, I think one has to be very wary of investing in these areas, which is the reason we believe, I think and if you see, the RBI has been very, very pragmatic about the way they've gone about this whole thing. I mean, they've built reserves. If you look at it in terms of reserves, we still trail peer group. So there's a long way to go in terms of building reserves. So be it a balance sheet imperative, be it protecting domestic industry, be it boosting exports, we need to get the rupee lower.
Well, we need to, but it's just not sinking enough. What's just the numbers that you all are working with in terms of Fed and rupee?
So similar on December, 25 basis point hike, and the continued hikes next year, much more bullish on US growth next year per se. What it means for India, rupee forecast is 69 next year. We are less concerned about rupee strength hurting exports per se, because we've seen historically small 5-7% or 10% overvaluation doesn't affect competitiveness. You need much bigger moves for competitiveness to come into play. So we'll worry less about that as of now.
Okay. Well, just one number from all of you before I get back to the house. What's the Nifty return? 12 months down the line. December 2016? December 31st, 2016?
So our target is 9,200.
Not very ambitious. Ridham.
Mid-teens. So about
Give me a
15.
number for Nifty if you...
Yeah, so I have a Sensex number, so
Okay,
we'll
okay,
translate
15%.
that. Yeah, that's 30,000.
Okay, so it's a 15% appreciation that you would expect. Gautam?
We don't have an official target next year, but we'll be looking at 10 to 12% upside.
About 12% up.
10 to 12%.
10 to 12%. Bharat?
Well, I mentioned this on your show a month back. The Nifty touches 9,000 sometime in 2016.
Okay. So if you catch the time right, then there is a 10% gain waiting to happen that at best.
More than a 10%, Latha. I just think that you have to be wary of the fact that next year is going to be very volatile for global equities, purely because of, if conjecture just at some point in time if the Fed realizes it's behind the curve, there could be a lot of difficulty. So, I mean, this is a market which you want to trade.
You want to trade. Okay, I guess the unanimous answer from everyone is that mid caps would do better than large caps, better than the big indices. Rakesh? I cannot ask you a number, but if you can, mid caps.
Yeah, I mean, it appears that mid caps will continue to outperform large caps. more so because we are expecting domestic money to be one of the key drivers. So I think they'll continue to plow money into mid caps.
It actually reminds me of 2006, Latha. I had written a note called "My Mid Cap is Fine." I think that theme will be there in 2016. Every portfolio manager will assure you my mid cap is fine. I worry about that.
Okay, that's a very interesting theme, really, and I'm sure you're going to get a lot of questions from Franklin Templeton and from ICICI Pru on that. Bharat, would mid-caps outperform? Continue to outperform?
Well, Latha, you have to again appreciate that, it's very difficult to make a broad call on the mid-caps at an index level. I guess what happens is, you invest in mid-caps because you like the particular unique story. So, if you like that story, then, you shouldn't really bother about the index.
You should also watch Wizards of the last street. Gautam.
Over the long term, yes, but for next year, no. So our
Next year would be more heavyweight.
in line or underperform the large caps.
Okay. Well, I think those were the simpler questions that you got. The tough questions are coming. Over to Rima and Nigel, if I'm not mistaken. Okay.
Check. Yeah.
Well, the experts are now open to